Hey everyone, it is Evan here from the Trade Risk on Friday, April 17th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So we're going to jump right into it here with our technicals dashboard. You can see Friday closing strongly green right across the board. Russell 2000 getting a nice bounce here into the close of the week. However, if we look at the weekly performance, we can see that the Russell was in fact the only of the major indices to close negative here. And look at the difference between the Russell and the Qs. Russell closed minus 1% on the week. Qs closed up 7%. That is a very wide range there and divergence in performance. The week kind of getting weaker or staying weak in the Russell. Nasdaq back to its leadership status, helping move us higher. So we'll talk about that in a little bit when we get into the charts. But overall, when we look here at the major indices versus those key simple moving averages, you can see the SPY now starting to reclaim the 50 SMA, joining the Nasdaq 100, which has been above the 50 for a few days now, and is also above its 200 simple period moving average. So we're seeing improvement here for the major indices relative to some of those longer moving averages, sort of trend filters, if you will. If we look at sector performance, biotech really screaming to the upside, mostly thanks or certainly helpful with Gilead out on Thursday with the big gap up with some potential promising treatment there. And I believe we'll look at that in just a minute, but I think we closed at new multi-year highs here in biotech in the IBB index. So pretty impressive there. We'll talk about that later in this video. Semiconductors were number 2 here, followed by healthcare on the upside. And on the downside, we saw financials, materials, utilities all staying negative here on the week and underperforming on a relative basis. Now, in terms of major markets, it was the SPY at the top of the list, followed by emerging markets and TLT. So quite an interesting mix there to see TLT in the top 3 along with equity and risk on. But that's what's happening right now. And on the downside, we have oil down 15%, still struggling to catch its footing, closing at multi-year lows or pretty close to it. VIX continues to unwind, and high yield down, high yield credit down 1.6%, underperforming in this group here over the past 5 trading sessions. So with that, let's jump into the charts. Let's take a look at what's gone on here in the S&P 500. This is the weekly time frame we always like to start our analysis with. So each bar represents 1 week worth of trading. Now, there wasn't actually a whole lot that changed this week from, at least in equities, from a price action perspective. We basically are continuing in this recovery bounce or in this rally that we've been in now for 4 total weeks. Starting from the end of March here, we've been rebounding to the upside and retracing a lot of the carnage that unfolded throughout February and early March. And the market is continuing to enjoy a nice rally here, working off those oversold, those extreme oversold conditions. So the picture here, if we were to throw Fibonacci sequence on here, if we were just look at just general retracement levels, the S&P 500 is retraced over 50% of this leg down. So starting from the highs here, the top of the market in February, down to the lows 4 weeks ago, we have retraced now 50%, over 50% of that move, and we're working our way up to the 61.8% retracement. Now, one of the ways we've been looking at this market here, at least in the short term, was with this measured move here. So if you're a fan of measured moves, if you were to take this first leg off of the lows and you were to project that magnitude on this second leg higher here. So we had that first leg, we had a little bit of a pullback, put in this higher low, and then the markets continued higher, and it's the current kind of place and path that we're on right now. You would see that that brings us into kind of this zone up here, this 2900, lower 2900 zone, and that does coincide with the 61.8% retracement we just looked at with the Fibonacci. It also coincides with a gap fill in here, and it would complete complete this measured move. Now, I don't necessarily view this as a exact, I'm not looking for an exact level here. In fact, even where we closed on Friday is sort of close enough. It's getting into this general area here. And it's, the way I look at this is that it is a reasonable spot to expect the market to take a breath and perhaps reverse course. In other words, if getting back up to this zone here around 2,900, I would not be surprised to see the market hesitate there and potentially put in some type of short-term top. It certainly doesn't have to. It's not a prediction in the fact that we're going to just get up here and that's the end of it and we're just back to the lows. It's just a reasonable spot to expect some overhead supply, some technical resistance to kind of come into play. And of course, if we were to look at the distance traveled off of the lows up to this point, you're looking at about a 32% rally if the S&P 500 gets up into this zone. So we would have basically had a 32% for more or less straight line move. We had a little bit of a pullback and we've got some chop in here, but it's been pretty pretty relentless at working itself higher here. So all of those things, kind of combined, I think gives you a good sort of, area to expect this market to hesitate, to expect this market to find some trouble rallying above. And it's context in itself to know that with all of those things kind of sitting in this general area, if the market totally disregards it, if the market, completely cuts through it and doesn't even acknowledge or hesitate at this area, then again, it goes to demonstrate and show you and tell you more clues about this context, about the strength of the underlying market here and the fact that it doesn't care about levels and areas that it usually does in lots of, other market conditions. So that, I think, is still a good level and area to pay attention to on the upside. If we were to draw out some other areas here, so we basically have the 2,900 zone there that we just talked about. Above that, then we start looking at the highs here. So this little pullback we saw at the end of February, and pull back to the upside, that is. But that bounce we saw at the end of February into about 3130, that would be the next big relevant level over this 2900 zone that we could start putting on our radar if this market continues higher. Now, if it does roll over, if we do start seeing some volatility, if we start seeing this market move to the downside, 2640 or 2635 more specifically, that's still the most relevant area I would say to pay attention to on the downside. Again, it's been the last sort of breakout zone. It was where we put in that higher high and we got above the March resistance here. So 2635 is what I'd be paying attention to, and that is a pretty wide range in here. So that's why I think it is important here if the market does roll over and start, breaking below prior day lows, then I think we do have, certainly room for a, 8 to 10% fall back into this zone here. So those are some of the nearby levels I'd be paying attention to. If you're a very, very short-term trader, of course, you could be looking to get closer on the action here by looking at kind of the slope that we've been rallying higher. You could look at taking out a prior day's lows and closing below a prior day's lows. Those are all more nearby sort of signals that you can look for potential trend change. So that is pretty much the same, kind of the same outlook and same roadmap that we outlaid last week. So again, not much changed this week. The S&P 500 mostly went sideways and then had this nice pop here into the end of the week. So basically, we've got to continue to grind higher here. Short-term bulls in control. Intermediate term starting to get to some more frothy levels in this bounce. Now, if we were to look at the Russell 2000 here. The Russell 2000, in fact, did close negative. It was the only index to close negative this week, but it did see a nice pop higher into the end of the week. So it was up 4.5% on Friday. Thankfully so. Otherwise, this would have been more firmly and deeply in the red for the week. But notice it is still holding on to this pattern of higher lows. This isn't quite a higher low yet. It just has potential to be. But basically, for the Russell, this 117 level, it danced and flirted with it this week. It didn't really break down below it. It did close slightly below and right at that area on Thursday, but then it got a big save here on Friday. So basically for the Russell, I would be just, again, doubling down on this 117 area all the way right across here. If this starts to lose 117, then I think this index is in trouble. It looks like more of a kind of a bear flag breakdown, if you will, or something like that. So I would be cautious there if we start breaking below 117. But until and if that happens, again, just like the SPY, the short-term trend remains higher. So the bulls are the ones getting rewarded right now. It doesn't matter how stubborn you are or how much you think the market should maybe not be rallying. In the short term, the only thing that paid this week was being long and bullish on the market. So again, until and if that changes, you got to be cautious, either step aside or kind of playing on the long side. So the Russell continues to outperform. The Nasdaq, though, is the bright spot here, and it is just powering higher, totally ignoring any of the worries out there. You can see it's back to the same level we talked about as the next level as the S&P 500. It's almost back to its kind of February bounce that it saw at the end of February here. This 219 level, again, I do think like that would be an interesting spot to pay attention to find some resistance here in this market. The Nasdaq towards the end of the week here, you could see looked a little bit tired. It was up only a little 1% or so. On Friday. Compare that to the Russell, which was up 4.5%. Compare it to the S&P, which was up 2.5%. So the Nasdaq here into the end of the week looking a little bit sluggish, and deservedly so, because it has basically been up 6 days in a row, 6 out of the past 7 sessions. And a lot of the stocks here, I mean, there are some even breaking to new all-time highs or new 52-week highs, but there's also some that are quite stretched in the short term. So the Nasdaq has certainly helped lead the market here. Looks a little bit tired. Maybe there's some rotation into Russell 2000. Maybe this is what keeps the bull case alive here and acting well, with some sector rotation to some of the more beaten up areas of the market. But for now, Nasdaq continues to just charge higher and help fuel this move to the upside. So that is the market environment as a whole. Again, not a lot changing in terms of near-term trends. Still remain up from last week. We are in earnings season, so again, remember that. We got lots of catalysts out here. We got a busy week on deck for next week, so do pay attention to those earnings dates if you have any of those individual stock holdings. So let's move into some other majors now. We'll go to TLT, which on the week here did finish up 1.5%, and this starts to beg the question and starts to just wonder here, can the TLT continue to rise as strongly with right alongside of equity markets? So essentially saying that we're not seeing the TLT kind of give up and consolidate. We were really looking for that. We were rooting for it, especially in here. We were really looking for the TLT to take maybe more of a breather, start coming down into the 160, low 160s, and start just kind of, flattening out here and digesting. And then you saw, of course, it was off to the races on Wednesday and Thursday of this week, pulled back on Friday, kind of back at this resistance area around 170, but still TLT is not giving up here. So again, a little bit of a yellow warning sign flag there that the TLT, that the bond market is not slowing down on its advance higher too. So it gives you a little bit of a warning there in the back of your mind. But again, in the short term, again, we'll follow the price action and wait for any of those reversals or transitions to happen. So TLT stays bid. Gold pulling back this week a little bit. I mean, it's still basically closed flat. You can see a big tail here on the upper end. So maybe this is a sell signal for some of you here where it tries to break out above resistance. It rejects up there, closes back in negative territory, puts that big, inverted bar on a weekly basis there. So we'll see if sellers get follow through, but if they do continue to sell us off next week, we'll be back below and into this range here. And maybe we've seen a little bit of a top there for gold in the short term. Silver, if we look at silver next here, you can see kind of similar. I mean, it was down 1.3%. Again, I just dislike silver a lot more than gold here, and from a technical perspective, this looks like more like it could be a bear flag here, and maybe that was the entry or the rejection, kind of week one outside reversal. Again, closing low. We'll still need to see that sellers actually follow through to the downside here, but silver looks like at least wants to pull back a little bit and cool off after a strong bounce to the upside. Last but not least, if we look at energy here, USO back to the lows. Heavy volume still continues to pour in, but it's still a very difficult spot. I mean, we're back at the lower end of the range. We do have some positive momentum divergence. So maybe there's a trade here. Again, if you're short term, if you're active, you're back at the lower end of the range. You can define your risk. There might be some opportunity there, but it's still, of course, in the context of a steep downtrend and, a commodity that's just facing pressure from all aspects. But, sentiment might be as bad as as you're going to see, and maybe this is the low. So there's something to see there. There's something to look at, but again, still, no plan or interest is certainly in my standpoint or system that's going to trade that. Natural gas also, getting some life off of the lows here. So natural gas effectively came back and tested the lows just like USO did. Difference is we saw the sharp move above it or launch back over it. Heavier volume, saw more follow through on Friday. So natural gas, again, trying to dance around here and find a bottom just the same. So those are all of the majors. Let's look at some sectors now. Let's take a look at the sectors that outperformed and underperformed. So if we look at the upside here, XBI, this is top performing sector. This is, again, equal weight biotech. But just take a look now at how much of this move it has retraced. So we're seeing, again, just continued move to the upside here, and working itself back up to levels seen back 2 months ago, a full kind of V shape, a full round trip motion, not quite, but almost there. If we were to look at the IBB, we do have the full round trip trade here. We started up here in February, of course, trading just under these multi-year highs, and we had this nasty, 30% or so. Let's see what was the actual percentage there. Yeah, it was almost 30% that it sold off. And now just as quick as it sold off, it's back here and closing at new highs for the IBB. So some impressive strength, high volume, big gap coming in here. Be interesting to see if this move can continue and hold, but seeing just, again, a lot of excitement here in biotech. It's a tough market environment to want to chase it, but there's certainly a lot of momentum hiding out there in the short term. If you're active and if you can manage risk, there's some opportunity. Last but not least on the upside here, semiconductors moving back over this 128.50 area, which was where we saw, this has had some inflection around 128.50 in the past. We saw this, kind of a stall out here late last week, but it continues to march higher here. Looks like that Nasdaq 100, where it just is continuing to lead the market and hasn't given up anything just yet. Now, on the downside, financials was down 4% on the week. Again, you can see it's still clawing its way back here, but on a relative basis, it's still much closer to the lows than it is to the highs. There's still lots of overhead supply, and this is still just a more troubled area of the market right now. So XLF, it is continuing its move, but certainly a lot weaker than lots of other parts of the market. Materials, kind of the same thing. It's a little bit more aggressively bounced off of the lows, but there's still a tremendous amount of overhead supply that it's about to come into. So XLB, I mean, it'll continue to work so long as the broad market works, and it is some of the more beaten up areas of the market, so maybe there's some more froth to happen or rotation, but it's still a very difficult trade from a technical perspective to really like. Last but not least is XLU. This one here, much more interesting or much more attractive, at least from a price structure basis as well. Just more, much more closer or in the middle of the range, closer towards highs than it is to lows. It's putting in some sideways consolidation. It's putting in some higher lows, and it looks like it's trying to work itself higher now. So XLU just looks better here out of the bunch, even though it was the third worst performer this week. Still looks, one of the most interesting compared to financials and materials. So that is it. That is the recap for this week. Lots of cross currents out there. Again, you need to have a plan. You need to know your time frame so you can survive in this market, so you don't FOMO into these moves, and so you can really just understand what type of trader you are, because there's a lot of confusion. There's lots of arguments and debate going back and forth about, is the market healthy, is the worst behind us, and a lot of those things can be clarified by just discussing time frame, because time frame really matters here. If you're a very short-term trader, then things still look good as we continue above some of the fast rising moving averages. If you're a more intermediate term trader, then you got to start to worry and start to look at some of the things we talked about, like running into resistance here to take more into context this larger trend, so on and so forth. So hopefully that's helpful. Hopefully these videos are helpful. Thank you so much as always for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend. We'll see you back here on Tuesday for the midweek recap.